Special conversation this morning. Let's go across to Nikunj, who's sitting down with Atul Suri.
It's time to really first get a sense on where momentum and where charts are headed. We may talk about the concerns in the economy, the underlying fabric of earnings not being strong, auto sales have been declining for many months now, and the feel-good factor for the economy is missing. But if Nifty is anything to go by, and if I top it up with the global mood is anything to go by, looks like bulls cannot put a foot wrong. So why is there a dichotomy between underlying earnings and the stock prices? It's often said that markets, they map earnings. Earnings have not been there, yet why markets are going higher. So we'll talk about with Atul Suri today. First, the big picture on globally where the trends are, what it means for India, how can one create wealth? Trends are all about not identifying today, tomorrow. It's also identifying something which is small can become large and something which is large can become mega cap. So today it's going to be one of those freewheeling chats which I've never done with Atul. Atul, fantastic to have you. Thank you for joining.
Thanks, sir. Yeah, why not? Change.
Markets haven't changed at all. The look is still the same, 15, 20 stocks, and that's about it.
No harm. Really, there's no harm, So I know there's a lot of angst that the market is very, very narrow. But let's take a bigger view of the markets, Nikunj. So I look at something called the MSCI All World Index. It's like the mother index of the world. It has 49 countries in it. And you'll realize that I know we have a lot of negative news. Our WhatsApp is full of, doomsday, world ending, end of the world scenario. But markets are doing their own things. They are saying a different story. So the MSCI All World Index is just broken out into lifetime high a few weeks ago. Now you may say that, well, it's a function of US because ultimately which global market is doing well, what is headlines, it's US. So the moment you say it's US, so let's go and see the US. That's true that the Dow, S&P, in fact, the Dow transportation has started coming up, utilities is coming down. So this is inverse. So risk on trade is on in the US. And when I look at the charts and I look at, a lot of triggers that are happening in the US in the year, whether you've got elections, you've got trade wars, corporate earnings, and most important being bond yields, I personally see about a 20% upside in the US markets from here.
20%
upside in the US markets from
after a 11-year bull run in the market, what has been called as the longest economic expansion.
Right.
Did I hear you right? 20% more?
That's right.
That means Dow could go to 35,000?
I think so. And what I feel is that this is not just going to be the US. Let's go a step further. So we looked at the All World Index. We took out its biggest component, Dow, which is 50%. So I look at
All World Index is what?
So the All World Index is a composite index of 49 different markets of the world.
Okay.
And out of that, they pick out various components. So it's it's the most broad-based equity index in the world. And there's an ETF available. Okay. So you can actually trade it. So if I say I'm bullish global markets, I can actually buy the world indexes in one ETF. Then I go to the next level, is what I look at. I look at this all world index ex-US. So I take out US. I think that, okay, US is the only propulsion point. Rest there's gloom and doom. The other big component is the European markets, which have been dead and nobody talks about. But even there, you will start seeing that the DAX or the CAC, which is Germany and France, UK has its own problems, are nudging 52-week highs. Nobody talks about them. They're not headline news. Let's go to the next level. Let's look at Japan, Nikkei. Okay. Again, a forgotten market. Even that is pushing at 52-week highs. So what you really see is a very, very broad-based global equity bull market. Very contrary to the kind of WhatsApp and tweets that we get.
But Atul, global markets have been in this good groove for not 1 month. Dow has been making a new high for almost 3 years in a row now.
Right.
Indian markets also have managed to outperform, at least the Nifty has managed to outperform, and it's making a new high on a consistent basis.
Right.
So some would argue, what is the new trend what Atul Suri is just telling you?
So what actually happens is that equity markets have been very good in 2019, but 2018 was a very difficult year. 2018 December, we were in the depths. And the biggest trigger for that was US bond yields.
Okay.
Exactly a year ago, if we were sitting here, the talk was that the bond yields, which have been declining for this 20, 30-year thing, has turned. And as bond yields go up, money will move away from equity to debt. And just a year later, people are talking of negative interest rates. So that shows our ability to predict. And that shows ways and means of markets to surprise us. So what is the biggest, I think, the biggest elephant in the room, which is bond yields. They drive all of the asset classes. Last year, we thought that a 30-year-old trend had changed, and this year we're talking about negative yields.
We got a headline 2 weeks ago, not even 2 weeks ago, 10 days ago, that there has been a big spike in the US 10-year.
There has been.
Right? That tells you that the inverted yield curve, which took the markets higher,
right,
that is equalizing. So if your bullishness is based around UN 10-year paper, guess what? That is reversing.
So what will happen is that it's not just that if it has a pop-up, it's going to reverse. The fact is that if it remains within a range, even two negative inverted yield curves, etc., is not good for markets. But most important for things like currencies, for things like bond yields, is the range boundness. So the good part is that the collapse has stopped, but I feel that we will go into a period of range boundness. So this is again coming back to our earlier thing, that the big trigger for global markets will be a muted or a range bound US bond market. If that remains, what will happen is that there is this very big TINA factor. There is no alternative. That is also playing out in India. So I feel that money will move to equities. And let me take that whole, deduction thing ahead. So we really spoke about last was about Japan being another great bull market. The next step I would look at is the EM space. And the only place of big concern or underperformance big time is the emerging market index. And guess what? We are a subset of it.
Okay. It is also believed and been documented that emerging markets will do well when developed markets are not doing that well.
Right.
They both are a mirror image of each other. There is an inverse correlation because one goes down, other goes higher, other goes down, this one goes higher.
Right.
What you are saying is that, folks, let's just scrub the blackboard. Theories which have worked in the past will not work in the future. We are in a rising tide phenomenon where everything will go up in a synchronized manner. Right. Why is that?
So what happens is that I've been speaking about this developed markets, or what we spoke about. As I said, the EM's index is not looking that pretty. So EMs as a space, coming back to your earlier point, that is a fact. That when you speak to investors, they said that why should we come, like in 2018, the EM index was down 25%.
Yes.
And in 2019, when there's a very big bull market, at best we've done 10%. So we are nowhere near lifetime highs or 52-week highs where the EM basket goes. So the compulsion to be in EMs is not there yet. Yes, the potential is that this trade could reverse and this could kind of disproportionately benefit India, because whatever the FII flows, sometimes we get confused why FIIs are buying, how come they are buying 2 days, 3 days. The direct correlation is that there is a very large passive ETF EMs trade that goes out, and India gets its share of allocation. It's not about some number here, some things. We tend to overemphasize the local factors, but the big EM money that comes is more a function of this trade. So let me shock you with a number. Last year, the total FII flows, negative flows, are around 53,000 crores or thereabouts. In 2018, it's 19, though we may sound passive, we've already positive 58,000 crores.
Yes.
So the buying this year has been more than the selling last year, though that was headline news. So the thing is that EMs, which fell very sharply in 2018 at 25%, in 2019 have consolidated. They are 10% higher, but they are nowhere to what the developed markets are doing. So for me, it's a very interesting thing that the opportunity is that maybe this whole EM trade reverses, and that I think can lead to disproportionate flows to India. And that I feel is what really the benefit is. And for India also, you have to accept, as you started, that the headline news is not good.
So it's like a situation where markets will continue to climb the wall of worry. Like a common friend Rakesh Jundwala says that markets always climb the wall of worry and come down the ray of hope.
Right.
So right now there is no hope, but there is a wall of worry which markets have managed to climb.
Right. So we have a very good global scenario. Now we will get our share. We have got it in the last year without doing anything spectacular in 2019. There's been no great news. The issue for India, what I see are the opportunities that 2020, starting from the budget, can we do something great? Whether it is government policy, it has to be government policy, whether it's the area of divestments, whether it's a case of direct taxes, or just general economic improvement. In case that happens, I feel India can get a bigger share than what is due to it. And that for me can be the big space. So I think that going ahead for us in 2020, we will have a good market, thanks to the global bull run that there is, in spite of all negative headline news. However, for us to go out and make from good to great, is going to be a function of what happens in Indian markets. And I think 2020 is going to be a very exciting year.
Okay, so we'll talk about long-term trends here, and some of those charts will just come up on your screen. I want to pick up first the outperformers.
Right.
The classic outperformers in last 5 years. There you go. This is what has happened to Nifty in last 3 and Bajaj Finance. It's up 375%.
Right.
I can throw in an iShares, despite the lofty correction.
Right.
Talk about a titan.
Right.
If your view is that we are in for more of the same, which
Right.
is that markets will continue to extend themselves,
Right.
will the horses also be the same, or you need to jump off the horses now?
See, jumping off the horses is a good thought. It is intellectually a great concept. But see, I'm a trend investor. And investing styles are not a intellectual function. It is a function of your risk-return profile. So, as a trend investor, I do not believe in being the first to buy a stock or buying a stock at the bottom. I feel that money is made in trends. So, if a stock goes from 100 to 1000, it's not that I have to buy it at 100. I can buy it at 200 and 300. The more important part is my ability to ride the trend. So yes, I know there is this talk that there is a bubble in some space and some spaces are cheap. But the fact is that when the market or when earnings change, I may be not being buying at the bottom, I may buy it a little late, but it's okay because that suits my risk return profile. As an investor, you evolve, your thought process evolves. And at some point in time, you realize
Are you an investor or a trader?
I'm an investor.
Okay. I thought you were a trader.
So again, what are investors, what are traders? What is mid-cap, what is large cap, what is quality, what is not quality? These are all relative man-made terms. So the fact is that ultimately each investor's style has to be in gel with what is his personality. That makes your style of investing, and this has to sync with your investor expectations. I think that is the crucial part about my evolution as a thought process as a trend investor. So coming to your question is that are all these stocks, is the top made or is it a bubble? I don't think so. Nothing today in the market tells me, whether it's in the space of earnings or price move, tells me that there is a bubble. Yes, the other story can also play out, but the fact is that let the earnings come, let them play out. We may not buy a 100 to 1000 journey at 100. We may buy it at 200, 300. But I want to buy it at a point where the risk is low. I'm not one of those kinds, who will buy a stock at 100, wait for 2 years, and at 50, get disappointed. I would rather buy it at 200 and 300 and go see it go to 400, 500. So that story is panning out in this space, and that is where the trends are. And as a trend investor, I'm quite happy to be there.
I just want to look at the iShares chart here.
Right.
If I look at the 5-7 year chart, iShares has still given a phenomenal return.
Absolutely.
But if I just squeeze in the last 2 years of performance in iShares, it's been for a trader, it's just been a nightmare. A 40% decline from the top and a 40% recovery from the lows. There you go. This is iShares for you.
Right.
In last 3 years, right?
Right.
It's flat. 3 years chart for iShares is
That's
flat.
right. That's right.
Let's look at the 3-month chart for iShares of the 4-month chart of iShares, and it's like one of the scary volatile charts which will tell you that where the top is, where the bottom is. But this does not look iShares to me.
Right.
34% in iShares. Now let's look at the last 5-6 year chart of iShares. Again, it's a very different kind of a story. How do you deal with this kind of volatility in what has been a zero debt company, a classic compounder?
Absolutely.
When you see stocks go down by 40-50%, it just shakes you.
Yeah,
it makes you nervous. It gives you that bad feeling, am I going wrong? There you go. iShares last 5 year, great return.
So this is the beauty of numbers and statistics. Based on what view you want, you can splice data, and that's how reports are made. So the thing is that what is your projection? And all these things are academic discussion. The important part is what is your style and what fits. So I really don't need to look at iShares at 3 months, 1 year, 2 years, etc. The important part is, as a trend investor, I am trying to look to invest for 3-5 years. So if I'm playing with that kind of strategy, then I have to give that stock that kind of leeway. So let's not speak about iShares specifically. The fact is that
that's an example.
That's an example.
Example.
Right. Yeah. So the fact is that what data you splice, you can make it a bull and bear case based on data.
All I'm saying, Atul, is that a classic compounder like iShares also has given you these nervous moments.
Absolutely.
It has given you these bouts of gut-wrenching volatility.
Right.
In auto company falling 40%,
absolutely,
which has no debt in it, you would say, "Arey, ye kya ho gaya?"
Right.
I mean, I did my homework.
Right.
I can see bikes on the road.
Right.
It is zero debt.
Right.
How can a stock fall 40-50%? I mean, it cannot be compared like a power company in a PSU bank.
Absolutely.
But yet the stock has fallen.
Those are markets. The smoothest stock in Indian markets today, most widely owned is HDFC Bank, right? I think one of the least volatility. But you will find in the history of this stock also that it has had its 20-30%. So at a bank that's growing at 20-25% year on year, no blemishes, how can the stock fall 20-30%? But those are markets that are a function of multiple variables. So as I said, the important thing is that the objective, I as a trend investor, is about having portfolios with low drawdowns, because that doesn't suit my personality. Yes, I would like a portfolio that goes up 100% every year. But the fact is, if I look for a stock or a portfolio that goes up 100% every year, can I withstand a 50% drawdown? Because risk and reward go hand in hand. So as an investor, it's important for you to be able to define what is your area, which fits into your psyche.
How does stop loss come in? You say that stop loss is sacrosanct for me.
Stop losses are sacrosanct because what happens is that when trends change, right, whether these trends will change in earnings firstly, and you will see that same price trend change, which again you were speaking about Aisha. The thing is that you fall in love with stocks. I'll give you this case of Aisha, so it may just be a bit of a storytelling. So I rode this stock in a long
Not
phase.
the bike, the stock.
I don't know how to ride a bike.
Okay.
So
that's a good disclosure.
Yeah, so no, it's beautiful. Actually, that's where the story goes on to. So I love the stock, and Aisha and Royal Enfield had opened these lovely stores, and there was one that opened in Bandra. That's where I live. And I went there and I said, wow, this stock has been kind to me. Let me go and see what the hell the bike is all about and things like that. Because it was a very fancy store with selling leather jackets and things like that. So I went in and I saw I said, see, the bike I can't buy. I don't know how to ride a bike. So maybe I buy a t-shirt or maybe I buy this.
My loyalty to the company.
Yeah, I got to contribute something. So I went and saw a keychain. I said, yeah, this is something I'm going to use, because everyone uses keychains. But that's where I stopped myself. I didn't buy the keychain. Because that is where emotion comes in. And I checked myself from making that emotional decision. Again, this is my story and it is my way. So the thing is that when stocks do well or when trends happen, we fall in love with them.
No, but
and the exit decision, what we spoke about stop losses, is not an intellectual decision. It is emotion. Selling is the most difficult thing in the market to do because that is where emotion comes in. If you sell in profit, you're definitely in love with the stock because you made money. And selling at loss is where your ego comes in. So the decision, what to buy or where is the trend is not difficult. Sitting on the trend is more difficult. And the most difficult part is exiting the trend. And the reason that happens is not because we failed intellectually, it's the emotional issue.
Give me 1, 2, 3 trends where you think, and since you said that you're a trend investor, right?
Trending earnings and trending prices.
Earnings and trading prices. Where do you think next 3 or 5 year trend is smooth? There could be bad days, bad patches, bad weeks, even it could be a bad quarter.
Right.
The stock could fall 10, 15, 20, even 30%. But you would say the trend investor in me would not lose his calm. Will remain committed and will not lose his sleep over this volatility.
So I think that private sector financials, I would say not the NBFC space, but you are seeing a very big trend play out in insurance, in AMCs. People think they've run up a lot, but I think that the way it has all the makings of very large trends. Again, I'm not saying what's going to happen in 1 month, they can be down in 3 months. But whenever I've seen very large trend in spaces happen, I feel a few factors come in. The first and foremost, it should be a newness to it. These sectors were not listed 3-5 years ago. In fact, there's almost a level of newness to private sector insurance in our lives. Number 2 is that the method of analysis, there should be very few analysts and you should be able to spin a very big story. So the whole Indian demographic story that you hear about.
We need insurance.
We need 25-year story and AMC and savings and look at US. So you can spin a very, very big story. So there should be a story to it. As I said, first, it should be a newness. You should be able to spin a story. Third is that there should be earnings. That there is no getting away from it. Otherwise, it's a bubble.
So is insurance like buying IT in 98? Is it like buying infrastructure in 2004?
Interesting, possible. And fourth, actually, which I think is very important, is under ownership.
Okay.
So you will find that no institutional investors, whether it's mutual funds, etc., had these stocks, and many seem to be even underweight. Very few people have it in their portfolio and having run up. So the demand for this stock, for this spaces is very, very high going ahead. So I think that these stocks or sectors exactly are the examples you gave me of these sectors. There has to be newness, there has to be a very big story possibility which you should be able to sell. there has to be under ownership, and most important, there has to be earnings. So what you really see are in these spaces, the earnings kind of also pick up. So these I feel can be very, very long-term themes. They have run up in the short term. Please don't hold me that 1, 2 months, 3 months. In case they correct, they may be buying opportunities. But I feel that going ahead, these could be interesting spaces to be in.
Where does private sector bank fit in? There is no newness in the sector.
Right.
There is extreme ownership in an HDFC bank and now ICICI Bank.
Right.
And there is still a very long highway of earnings.
Right.
How would you deal with that classic?
It's about earnings, right? As I said, that as you rightly pointed out, that they just consistently compound. So they will never give you, yes, they have done well. They have been done well in the last year or two, is because honestly they have been a bit of a risk-off bet, because things have been collapsing all around, and this is where you could actually hide. You know, it was so difficult in the last 1 to 2 years to be very brave and go out and try out something new, because you got it wrong, you got whacked 50%. Here at least you knew that was not happening because the earnings were coming. So for me, I personally think that money has flown to these spaces. They will not do bad, the earnings will go, but maybe the rate of change in prices may sort of moderate. They will still make you money, and you can already see that how money is moving into the corporate facing banks. Now some of the PSU banks are attracting, so money is moving out. So I think the biggest factor, the thing that I look for in this market is, for any big trend, is the TINA factor. There is no alternative. There was no alternative. If you went and tried some fancy NBFC housing finance, something comes out and you are down 30-40%.
So let me rephrase my next question very carefully. I don't want to get this one wrong. If you bought IT stocks, TMT stocks in 1995 to 2000, for next 10 years you did not make money.
Absolutely.
Right? You are in a single low-digit return for IT stocks in this decade.
Right, absolutely.
If you bought banks in 2000, private banks in 2000, 2001, you've hit a home run.
Right.
You've had 20% returns for about 15, 20 years.
Right.
Do you think private banks could do what IT has done in this decade, which is give you single-digit returns?
I don't know. Nobody knows the answer.
Knows.
Because the fact is that when trends play out,
No returns or low returns?
I think they are still giving good returns. My only contention in my earlier answer was that they had become a TINA trade or an investment last 2 years. The fact is that this banking space is broadening, and that may lead to reallocation. That doesn't mean these stocks will not do well, but the rate of change of price may come down a wee bit. So again, I'm not putting any red signs for it, but they continue to do well, they continue to hold, and they continue to compound. And one big mistake we make is always trying to predict how far these trends can go, because the markets can really surprise you on the upside, and you have to go and see history. So trying to find the trend, as for me as a trend investor, as I always believe and I truly practice, that tops and bottoms are for fools and liars.
You can't predict them.
You can't predict them, and I've seen that repeatedly. It may sound cute, we may have a great discussion, I may sound intellectual, I may sound a fool talking about private sector banks and trends, but hey, you know what? The market is that.
Okay, so let's divide the market into what could...
Okay, that's an interesting take. Tops and bottoms are for fools and liars. Atul Suri being very candid and talking about very strong projections for the global markets, for our own, and where there is opportunity. Well, what's going on with the markets at the current